Single premium private mortgage insurance? Yes, it is a thing. Hey everybody, what's going on? It's Jeff Trevarthen, Jeff the Mortgage Pro, for those of you out there watching my YouTube channel. If this is the first time you're here, I appreciate it. Thanks so much for coming by. If this is a video that you've watched a bunch of them before, please know that I really appreciate you guys following my channel. Do me a huge favor, click on the like button if you like this particular video, and that helps get the algorithm out there to show other people that I kind of know what I'm talking about. At least I think I do. And then if you are someone who likes to watch the show here, I usually put out videos on Tuesdays and Thursdays right now. And the subscribe button will let you know. And if you click on the bell next to it, it'll let you know when these videos come out. And my goal is to be the #1 loan officer on YouTube. Like I said many times before, I've got a long ways to go. I appreciate the support so much so far, but let's get the message out there for everybody else to hear, okay? So today we're talking about single premium private mortgage insurance. So remember that private mortgage insurance is when a loan is more than 80% loan to value, or in other words, you're putting less than 20% down on your property that you're gonna buy. You have to have some sort of a private mortgage insurance. There's 3 different types of private mortgage insurance that you can get. You can have what's called lender paid mortgage insurance. You can have what's called, the one we're talking about today, single premium mortgage insurance, or you can have what's called monthly mortgage insurance. So all 3 of those things are a different option, but today we're going to focus on the single premium private mortgage insurance. Mortgage insurance is dependent on a couple different factors here. We have credit is #1. So the better your credit, the lower your private mortgage insurance is going to be. Okay. So if you have really, really good credit, 780 or above, and you're not going to pay as much as somebody who has a lot lower credit on mortgage insurance. And then also, it's also down payment dependent. So anywhere from 5 to 10% down is going to have a higher mortgage insurance versus something that is 10 to 15% down. It's going to be a little bit lower. And then 15 to 20% down is going to be the lowest category of mortgage insurance that you can have. So you can kind of base it on like, hey, do I have really good credit, and how close to 20% am I putting down? The lower your mortgage insurance is going to be as you factor those things in there. So a lot of times people will opt into doing the monthly mortgage insurance because they don't know any better that there is this actual single premium that you can pay up front if you wanted to get rid of your mortgage insurance altogether. Oftentimes, depending on someone's exit strategy, the monthly mortgage insurance is going to be better because properties are appreciating so fast, they know they're going to be able to get out of their mortgage insurance before that period is up where they have to get rid of their mortgage insurance anyway. So properties appreciating really fast. You probably don't want to do this single premium mortgage insurance, but there is an option for someone to pay the mortgage insurance for you. And that is when you're negotiating a contract to have to buy a property, you could actually have the seller pay this for you. So if that's a situation, so maybe we have a market that is declining somewhere across the country in the United States, and that means that sellers are reducing prices, sellers are more willing to negotiate than they have over the last couple of years, then if you can negotiate somebody to pay out your mortgage insurance for you, that might be a really good idea. So you can do that with this single premium mortgage insurance. So here's an example. Someone's buying a $500,000 condo and they're putting 10% down, which is $50,000. And the remaining loan that they have left is $450,000. These people have good but not great credit of $700. So in this instance, the single premium private mortgage insurance is going to be $6,345, which is a pretty good chunk of change. If you were to do the monthly mortgage insurance option with this one, it would be roughly $143 per month. So you could either choose to have somebody pay for that $6,345 up front, or you could have the $143 per month extra that you have to pay per month. Now, depending on how you can negotiate this, and again, if you can get the seller to pay for something like this, that might be a really, really good option for you. But it only works in certain markets. If it's a highly competitive market, chances of you getting the seller to pay for something like that for you are probably not very good. So look out for that. But hopefully you understand what the concept of single premium mortgage insurance is. If you do pay it up front, it's actually going to be less over time than what the monthly mortgage insurance option you would actually pay over time is going to be. So it could be a good deal for you if you can find a seller that's going to pay for it. All right, that's it for today. If you have any questions at all about single premium mortgage insurance, if that's something you want to take a look at or look into, make sure you hit my calendar link down below. And I'd love to chat with you for 15 minutes, 20 minutes or so, and teach you a little bit more about single premium mortgage insurance and see if that's something we can help you out with. Okay, have a great one. See you on the next show.